Who doesn't love saving money on taxes? One of the most important things a financial advisor can do for their clients is help them be as tax efficient as possible, all while maintaining their long-term financial goals. At the end of every year, I do two important things for my clients that have non-retirement investment accounts to help them be more tax efficient. First, I plan for capital gain distributions. By anticipating capital gains for clients, we can make strategic sells to avoid unnecessary taxation in these accounts. At the end of every year, mutual funds and exchange-traded funds often distribute capital gains to their investors. What this means is there's different transactions going on within these funds throughout the year, and at the end of the year, the fund companies will pass that along through to investors in the form of capital gains distributions. These fund companies, the mutual funds and the exchange-traded funds, have to announce when their capital gains distributions are going to be and the distribution rate. So this allows us to plan and be more strategic when it comes to selling those funds. Second, I look for the opportunity to harvest losses in a portfolio. I specifically look for positions with a long-term capital loss or a short-term capital loss. By selling these positions and generating that capital loss, we're able to offset any capital gains in the account. This comes in handy when we have realized gains in the account from earlier in the year, or if we were unable to avoid capital gains distributions. Remember, these two strategies are really only effective in non-retirement investment accounts. If you try to do this in your retirement account, it's essentially going to be ineffective because those types of accounts are already naturally tax efficient in their own way. While there's not necessarily anything wrong with having to pay taxes, there's also nothing wrong with being as strategic as possible with how much you pay.